Introduction. Why isn't ideal inflation zero? Most modern central banks, like the Fed ECB, do not aim for zero inflation, but rather to keep it at a low, stable, and predictable level, such as 2%. The reason is that zero inflation is dangerously close to deflation, falling prices. Economists generally agree that deflation can be far more dangerous than inflation because it leads to economic stagnation. Therefore, moderate inflation is often seen as the grease for the wheels of the economy. However, this balance is very delicate. The disadvantages of inflation, the harms of high and volatile inflation. 1. Erosion of purchasing power. This is the most direct and felt impact of inflation. When the general price level rises, each unit of currency you hold buys fewer goods and services. Inflation disproportionately impoverishes fixed-income individuals, e.g., retirees, minimum wage earners, whose salaries or incomes cannot keep pace with price increases. Inflation acts like a hidden tax. 2. Uncertainty and distortion of investment decisions. High and volatile inflation makes it impossible to predict the future. Businesses cannot know what their future costs or potential revenues will be. In this environment of uncertainty, they shift from long-term, productive investments, e.g., opening a new factory, R&D, to short-term, speculative, inflation-hedging assets, e.g., foreign currency, gold, real estate. This hinders the economy's productive capacity and growth. 3. Inequitable wealth distribution. Inflation redistributes wealth in society often inequitably. Debtors versus savers. Inflation transfers wealth from creditors, savers, to debtors. If you borrow at 5% interest and inflation at year's end is 30%, the real value of the money you repay is much lower. The debtor wins. The person who kept money in the bank loses. Asset owners versus cash holders. Inflation protects or enriches those who own real assets, homes, land, stocks, while penalizing those who hold their income in cash. 4. Loss of international competitiveness. If a country's inflation rate is higher than that of its trading partners, that country's domestically produced goods become more expensive relative to foreign goods. This reduces exports as your goods become more expensive abroad and increases imports as foreign goods become relatively cheaper. The result is a widening of the trade deficit and current account deficit. 5. Menu costs and shoe leather costs. These are the operational costs of inflation. Menu costs. In an environment of constantly changing prices, this is the cost businesses incur to constantly update their labels, menus, catalogs, and price lists. Shoe leather costs. When inflation is high, people do not want to hold cash as it loses value. They spend more effort and time trying to move their money into inflation-protected accounts, e.g. as banks. This effort and transaction cost, metaphorically, wearing out shoe leather walking to the bank, is given this name. The moderate advantages of inflation. 1. Avoiding the deflationary spiral. The greatest advantage of inflation is that it helps avoid its opposite, deflation, persistently falling prices. Deflation can be catastrophic. Consumers who know prices will be even lower in the future postpone their spending. Why buy today when it will be cheaper tomorrow? This causes demand to collapse, companies to halt production, and mass layoffs to begin. Moderate inflation breaks this postponement behavior and encourages spending. 2. Reducing the real value of debt. Inflation reduces the real burden of debt over time. This can be an advantage, especially for heavily indebted governments, corporations, or individuals with mortgages. Their incomes rise with inflation, while their principal debt remains fixed. This can encourage borrowing and, therefore, spending and investment. This is the other side of the coin to disadvantage 3. 3. Providing labor market flexibility. This is the most emphasized technical advantage by economists. 4. Creating policy room for central banks. Central banks cut interest rates to stimulate the economy. What they want to cut are real interest rates, nominal rate, inflation. If inflation is 0%, the lowest a bank can cut rates to is 0%, the zero lower bound. In this case, the real interest rate is also 0%. However, if inflation is 2%, when the central bank cuts the nominal rate to 0%, the real interest rate becomes 2%. This negative real rate provides a much stronger incentive to borrow and spend. Positive inflation gives central banks more room to maneuver in times of crisis.